have been on a bumpy road to absolutely nowhere on the S&P 500 through most of this year. On Tuesday, the biggest one-day drop, I think, since May 4th. Then on Wednesday, the biggest one-day pop, move higher since May 5th. Your equity market right now just slightly negative by 0.1%. The data is okay. Are we opening the door to a move in June again at this Federal Reserve? There's your opening bell. Switch to the board and get to the bottom market. It's driving yields just a little bit higher by 5 or 6 basis points on a 10-year, back through 360, 361.91. In the FX market, it's driving some dollar strength. The euro, a break of 108, 107.88. We're negative on that currency pair. Euro dollar by 0.5%, and crude a little lighter as well, 72.36. We're negative there by 0.6%. About 20 seconds into this session, your equity market slightly negative on the S&P 500. Slightly positive on the Nasdaq. The one stock to watch at the open, Walmart. The retailer raising its full-year profit outlook, but delivering a word of caution, expecting inflationary pressures to linger. The CFO saying this: there's reason to be somewhat cautious on the health of the consumer. Abby has more. Hey, Abby.
Hey, John. Yeah, it's an interesting quarter, and right now investors are rewarding the stock, popping, having its best day in more than a month. So relative to the quarter, they beat adjusted earnings by 12%. They beat sales by 2 or 3%. So pretty solid. Now, the outlook, I'm getting different reads here. One analyst is talking about how the second quarter is a little bit light, but still strong. They basically held, but because of cautious activity that they're seeing out of consumers, they are not raising the guidance in a big way. That said, they're doing a little bit better, it seems, than some of their other retailing peers, such as Target. Now, of course, they do have, because of the economic environment, more shoppers who earn over $100,000. There's headlines out now saying some of those shoppers are going toward discretionary items. But we have Adam Crisafulli over at Vital Knowledge. He's saying that these results aren't perfect, that there was general weakness in merchandise sales as shoppers are pulling back on discretionary goods, plus lower gross margins, moderating gains in food sales, and a second quarter profit forecast. So I'm going to be curious, John, given the variety of commentary out there, whether or not these gains hold. But right now, up 2.4%. It seems that investors are choosing to see the Walmart glass as half full as opposed to half empty. 2 minutes in, slightly higher, as Abby indicated. Let's see if it sticks. Abby, thank you. Also looking at shares of Cisco, under pressure after reporting a 23% decline in orders this past quarter. The CFO saying this: what we are seeing from our customers is they are being prudent. Isabel Lee joins us now for more. Morning, Isabel.
Hi, John. Shares are indeed falling. 23%, that's not really a lot. And Morgan Stanley said orders slowed faster than expected, but still largely in line with their recent checks. But perhaps this isn't so surprising, given that Cisco is the largest maker of machines that support computer networks and the internet. But there is some good news here. For instance, they had strong sales forecasts and overall positive analyst projections. The CEO, Chuck Robbins, maintained that demand is steady and that the improved supply chain is giving customers more confidence to purchase equipment. He has tried in the past to recast the company as a provider of software so that he will encourage people to keep on buying and, bring in a recurring cost apart from that one-time purchases. So we'll see how that plays out for now, John.
Let's see if the name recovers. Isabel, thanks for that. Cisco's still lower by 2.6% about 3 minutes into this session. Let's shift the focus to Alibaba, the e-commerce company approving the spin-off of its cloud services division. Kelly Lyons has more. Hi, Kaylee.
Hey, John, yeah, the stock opening more than 3% lower all the same. The spinoff of the cloud division will happen within the next 12 months via a stock dividend distribution to shareholders, and the intention is for it to become an independent publicly listed company eventually. Now, it's worth noting that this announcement came in the context of the company's fiscal fourth quarter report, in which this division saw revenue actually down 2% versus estimates of 6% growth. You also saw a decline in growth in its China commerce business, so speaks to some of the underlying issues Alibaba is dealing with here, hence why they are looking at unlocking value in these different businesses. Not only will the cloud division be spun off, they also are beginning to pursue IPOs for its grocery division as well as its logistics arm. The company is also planning to secure external financing for its international e-commerce division. So taking steps toward unlocking this value, John, but still the stock not liking what it is seeing in terms of that growth. The revenue growth of just 2% in this quarter is the 6th consecutive of less than 10% year-over-year growth. So Alibaba is just not a company that is growing like it once was. The stock down 3.3% at the moment, John.
Just a bit softer early part of the session. Kelly, thanks for that. Here's a stock doing okay in the financials. PacWest extending gains to a second day. You can thank Western Alliance by reporting higher deposits. That really sparked a rally in the regionals calls in yesterday's session. In focus today, once again, we should hear from the Vice Chair of Supervision, Mr. Michael Barr, which means we're going to hear from Sonali Basak right now. Morning, Sonali.
Good morning, John. I don't know that the easing of the regional banking system here, the strongest rally you've seen in a couple years yesterday, I don't know that that takes the pressure off of regulators down in Washington. However, it certainly takes some of the pressure off of the stocks. You saw PacWest up more than 20% just yesterday. You are seeing more of a bump today. You're not seeing a widespread gain. And again, you and I have lived the same last couple of months here, and we know that these have been very, very volatile. You know, a couple of days don't mean much. However, you also have, for example, the likes of a Schwab selling money, selling investment-grade bond late Wednesday, $2.5 billion actually for better terms than initially expected. So that shows you an easing of the capital markets for the banking system in particular. Now, we know when it comes to the broader ramifications here, there's actually some benefits of private capital stepping in and taking in some of the lending capacity here. It eases some of that worry of the broader credit crunch. But again, remember, there are still massive holes in this market and a lot of jittery feelings about what the sector looks like right now. But a little bit of pain off the
We've
table.
heard a lot from regulators, as you know, and excuse me for jumping in, but I just wanted to be clear and keen to get your take on this. What do we know about the next regulatory steps? I saw a lot of politicians down in DC making YouTube videos for their constituencies for their next political campaigns. What do we know about the next real concrete regulatory steps?
It's a great point, because when you watch the hearings, they're kind of disappointing, aren't they? They're blaming inflation, they're blaming the Fed, they're blaming a whole lot of things that maybe doesn't matter to the banking system that still exists. But with that said, you might see some changes in terms of the way executives buy and sell stock around certain big events when it comes to the banking system in particular. We're not seeing wholesale changes when it comes to short selling. You will see a very interesting stress test this summer when it comes to the existing system, and the question is, do they widen those tests to a wider set of banks in the future?
Sonali, thank you. We'll catch up with you in just a little bit. I've been looking forward to this conversation. Jeffrey Sherman of Double Line Capital joined us now to talk about this market. Jeff, wonderful to catch up with you, sir. Let's start with the data this morning. I had this conversation at the start of the hour. Are we opening the door to another move in June at this Federal Reserve?
Well, I mean, if you look at some of the data this morning, too, the unemployment claims really continue on kind of an upward trajectory. And so if you look at the initial claims at roughly 250,000, is a little inside of that. The moving average, if you kind of take 4 weeks or so and smooth it out, continues to kind of chug upwards. And so, you know, I think some of this is really kind of portending some of the stress we're hearing. I mean, you guys are just talking about the banking system, and if you think about the lending mechanism, that transmission mechanism that creates credit through that system, that kind of hits the small to medium enterprise. And so as you look at that, I think we need to continue to watch that part of the market. We've got to watch the credit conditions as well, and I think that's going to also be a focal point. And so when you look at the Fed, they have some tailwinds to their back on the inflation data, and that's really what we call the base effects, right? Last year's data, in the next couple of prints, if you go last year, what you see is that they were very high month-over-month prints, and there's not the expectation to repeat that. And so you have this nice tailwind over the next couple of months for the Fed. So I don't think at this stage that they need to hike. I think they need to worry more about the stress in the system that you guys were just discussing before you brought me on. And I think that's going to be the focal point for the time being. So although the market's starting to take up a little bit of a price of a hike, to me it's still far away, and I think the Fed should stay at the pause mentality right now.
Do you think the data is sufficient, though, to eat away at some of the rate cuts priced in the second half?
Well, the rate cuts in the second half are really kind of a strange beast, because if you look at them, it's this orderly kind of cutting system that where they're just going to start to take 25 basis points off the table. And we all know, having experience in markets, that's not how markets work. And really what it's pricing in is a probability of probably a more significant cut. And so although I don't really expect to see that path of cuts, if there is degradation in the data, I could see the Fed cutting meaningfully. And And I think the way that looks is that they pause, they keep rates elevated for the next few months, and then potentially it's late in the game, there's stress in the system, and they need to act more aggressively. And so I think if the Fed is to cut this year, I think it's more sizable than kind of what the market's price, or at least the path. It's more of a step function downward, and it maybe a 75 or 100 basis points will eradicate some of those hikes we've seen this year.
This is something that Neil Dutta of Renmac, Gershon Diston found AllianceBernstein, also the same thing that you just said, basically, Jeffrey. Either we've priced in too much or not enough. It's kind of one or the other. The Fed's going to have to cut hundreds of basis points or not at all. The front end's repricing a 2-year higher every single day this week. We've talked about that repeatedly through this morning. We're up 7 basis points on a 2-year at 423. Jeffrey, as you know, a lot of people are getting comfortable going out further along the curve, going out to, say, the 10-year, anticipating lower growth and ultimately lower yields. Is that some way you're comfortable with still?
Yeah, and it's something we've been doing really for the last 14 months or so. And so we've been balancing out our portfolios because we still own credit in a fixed income market, but we want to own some of that, what I'll call back-end duration, 10-year and 30-year treasuries, really to offset some of that risk out there. But, I think when you look at the 2-year, even though we're talking about it's creeping up, you're about 422 or so, I think, before I came on the show this morning. And what you see there is that essentially it says that the bond market doesn't believe the Fed is going to be able to stay at this level, right? If we have a 5.25 rate and the 2 years pricing, let's say 4.25, there's 100 basis point disparity between there. So ultimately, the bond market is saying that the Fed can't stay at these levels for a prolonged period of time. And so these are the highest levels we've seen on the 2 years since we've seen stress in the banking system. And even we talk about the 10-year. If you look at the chart, since we had the banking crisis, we got this new range. We're actually at the very upper end of that range on the 10-year. And so we've been really bouncing between 330 and like 362 or so since we had the banking crisis a couple months ago. And so it'll be interesting to see if we can break higher. I think if you get meaningfully higher, it is a chance to actually add more duration to portfolios to not only offset some of this credit risk, but if you think about the other parts of your portfolio, such as equity risk, we think that the 10-year and the 30-year Treasury can actually provide a lot of value if there is a degradation in the economy.
Well, let's go to the other side of the risk spectrum for you in the credit market then. Jeffrey, can you tell me how you're managing your credit exposure at the moment, you and the team?
Yeah, so what we've been doing, kind of similar to what I was talking about on the interest rate side, is that we've been migrating up the credit spectrum. So we've taken down exposure on a dollar basis, so meaning the allocation of the portfolio is smaller to things like high yield bonds, things like bank loans. Bank loans to us seem to be one of the riskier parts of the market right now because that's essentially where Fed policy is directed today because the coupons have had to reset because of their floating rate nature. So these companies are inherently paying 500 basis points more than they were 1 year ago, or at least 14 months ago. And so ultimately, we think that there could be stress in the system there. You're seeing that specifically in the lower credit quality. So that is something that we are wholesalely trying to avoid today. We still own investment grade credit. We own it, kind of in those middle tiers of the investment grade market. But also, when you look at some of the securitized markets, such as, like non-agency RMBS, or even some parts of the commercial real estate market, there is a lot of value. And when I say commercial real estate, people panic and say, well, aren't you aware of all this office and the things that are going on in the space? Yeah. And I say, absolutely. But the thing is that there's a lot of headline risk there, but you can move up in quality in these assets. You can buy things that are like AA rated, AAA rated, that yield 7, 8, 9% today. So if you can underwrite the assets, we think that that's an area that investors should be focused on right now. Now, it's probably a little bit early. You definitely don't want to be delving down into the lower tiers of credit within the commercial real estate market, but I do think that there are some opportunities that investors are overlooking. And so as we're talking about a slowdown in the U.S., the other thing that we have been reducing our exposure to is emerging market debt as well. And so I know there's been a lot of fervor around the sector because I hear the story that the dollar's peaked, that's the time to buy emerging market debt, and I agree with that if you're in this cycle where where you don't have a U.S.-led recession. But if we're really curious about, or we're nervous about seeing a recession in the next 6 to 12 months, emerging market debt just does not compensate you for that risk today. So we're being a little bit more cautious in the portfolio. We haven't really made a lot of changes except buying a little bit more of CMBS in the last month or so. But since the banking crisis, our portfolio allocations haven't moved much because we were pretty well positioned coming into it.
Hey, Jeff, so much to unpack there. I could talk to you all day, but can I just pick out the FX component of that, the dollar call? Do you think there's a risk here then that we move to the other side of the dollar smile, so to speak? Do you start to get underperformance almost everywhere? Europe, China, which leads to this dollar strength and that kind of classic risk-off dollar strength move?
Yeah, that's my fear, and this is a debate we've had internally, is that what does the recession look like if we have one in the U.S.? Does the dollar rally or does the dollar sell off? And our portfolio manager on the global side was that, well, if the U.S. defaults, it's obviously a dollar down. But I still think that, this would still be a flight to quality, risk-off type of trade, which would probably lead to a dollar rally. But if you do get that, and we're going to recession, we're going to, throw a lot of fiscal stimulus at it, we're going to stimulate the economy, I think that's where you really want to be inherently short the dollar or long non-dollar assets. And so right now we haven't added to those positions. We're watching it. If we saw a little bit of strength in dollar, we want to add a little bit there. But again, I have a little bit of nervousness because again, just given the way that we've seen with like the Japanese market, right? The Japanese seem to be moving money out of the U.S. and moving over to Europe. So they're not exposed to the U.S. as well. So ultimately, it doesn't feel like people are very long dollars today, and so there could be that flight to quality rally. So I share your opinion there.
Jeffrey, enjoyed this. Thank you, sir. Jeffrey Sherman, great to catch up across a range of assets there. Your FX market, the euro against the dollar, session lows right now. Breaker want to wait a little bit earlier, 107.83. About 16 minutes into the session, equities just about negative on the S&P. Coming up, former regional banking heads taking a stand on Capitol Hill.
When contagion hit after the failures of the two other banks, panic sets in.
A conversation up next.
At the end of the day, when the panic sets in, it's really hard to regain confidence. And so absent some evaluation of the insurance on deposits, which I know the FDIC, I think, is requesting comment or offer proposal, I think that's one thing that would be worth looking at.
Well, you've got a new focus now. Is it the next shoe to drop? U.S. commercial real estate prices falling in the first quarter for the first time in more than a decade. According to Moody's Analytics, the less than 1% decline was led by drops in multifamily residences and office buildings. Moody's chief economist Mark Zandi saying, quote, lots more price declines are coming, a concern the Federal Reserve shares, writing in its semi-annual financial stability report that, quote, the magnitude of a correction in property values could be sizable and therefore lead to credit losses. The Fed Vice Chair for Supervision, Michael Barr, telling lawmakers this week they have increased their oversight.
We are looking carefully at commercial real estate risks. Banks already are in the process of working out commercial real estate loans where they see those risks in appropriate places.
Let's get to the team. Kelly Lyons, Shonali Basak. Kelly, first to you. What are you seeing on the policy front? The regulators' focus, is it shifting back to this?
Well, there's a lot of focus on making sure that regulators act within their existing authority. On the Republican side, on the Democratic side, they would like to see a tightening of regulations. Of course, we're going to have a third day of hearings on the Hill today in which regulators will be in front of the Senate Banking Committee. They were already in the House earlier this week. And of course, we already heard from the former executives of these failed banks. I just got the prepared statement from Chairman Sherrod Brown of the Banking Committee. He says he wants to tighten capital and liquidity and stress tests, consider options to deposit insurance reform, also that they need to improve our merger policy so that failed bank acquisitions by mega banks are only a last resort. It remains a question, though, John, of whether or not any of these measures really can find bipartisan support. Some in the Republican Party I've spoken with over the last few days have suggested that things seem stable enough that there may not need to be any kind of legislative response, just that regulators need to not be asleep at the wheel and act with the authority that they have. Of course, that's not the view of some in the Democratic Party. And I would note that one area of bipartisan support that we may see coming forward in the near future is the idea of executive compensation clawback. Senator Elizabeth Warren has introduced a bill in that regard. She told me earlier this week she'd like to see it marked up in the committee very soon. So we'll see what steps forward we really get, John. But of course, a lot of today is going to be scolding and grandstanding to a large degree.
Once again, Shonali, let's talk about this market, this one focus, commercial real estate in America. You speak to a lot of fund managers, a lot of people with exposure to this. What are they saying?
I think we have to look at a few things. One, I want to double down on this Moody's report a little bit, John, here, because the other part of the quote that Mark Zandi gave was we're on a razor's edge here. And their estimation for price declines is about 10%. Another important thing that's in this report that is underappreciated in the market, everyone's talking about offices. Everybody. Of course they are. And actually, if you look in the big private equity firms, they have data that is granular on just how empty these office buildings are city by city. But in the Moody's report, there's another underappreciated risk here. That is multifamily buildings. This is residential real estate we're talking about. So it's not just office buildings at this point that Moody's is worried about. And again, that is an area of the market that people are talking about a lot less than they are offices, which are more obviously facing potential distress.
Just a huge amount of focus on this at the moment, and that focus is not going away. Shonali, thank you. To Kelly Lyons as well. Just another day of a lot of noise down in Washington, D.C. We can't wait. On the S&P 500, negative by 0.1% in the early part of the session. On the NASDAQ, we're positive by about 0.3%. Up next, we'll get you the trading diary from New York. This is Bloomberg.
Authority.
26 minutes into the session, doing okay on the S&P 500, just a little softer, negative by 0.1%. Plenty of action in the bond market, repricing the front end of the yield curve higher. Monday, Tuesday, Wednesday, Thursday morning. This morning higher by 9 basis points on a 2-year, just short of 424 off the back of better economic data and some hawkish Fed speak as well. Will we get more of that? That's the price action. Here's the trading diary. Dallas Fed President Lori Logan speaking again at the top of the hour. We get U.S. existing home sales plus Secretary Yellen discussing the banking system and the debt limit later in the day. On Friday, Biden meeting with G7 leaders, followed by Chairman Powell. Looking to next week, JP Morgan Investor Day on Monday, along with more Fed speak, Bullard, Bostic and Barkin. Then on Wednesday, we get the Fed minutes. Let's get to the weekend first. From New York City, I'll see you tomorrow morning. That does it for me. This was the Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Thursday, May 18th. Here are the top market stories that we're following for you at this hour. The magic of Micron. Micron could land $1.5 billion worth of financial incentives to build a next-gen chip plant in Japan. That stock up 4.5%. And the beauty of Bentonville. Walmart raising its profit forecast while staying cautious on the U.S. consumer. That stock up by 2.2%. And the downside of a deal. The market stays stuck. Yields in the dollar push higher. We're going to see what can break. Market
markets out of this range. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Still living the range-bound story here. Do existing home sales help us at all here?
Yeah, equity market's stuck in a range. Bond market beginning to bump up against the top, though. We'll talk about that in a second. Yeah, we're getting existing home sales. I'm interestingly enough not putting too much store in what we're seeing here. They're a little soft, 4.28 down from 4.44. That number revised fractionally lower as well. Bit below market expectations. Month on month, negative 3.4. The thing is, Alex, that there are no homes to buy.
Exactly.
Nobody wants to move. They're all locked into their super low mortgage rates that they got a few years back, hint, hint, and now there is no supply. You compare and contrast this with the new home sales data, which is roaring right now, and you can see that in the home builders. I think that tells you a story that the housing market is two very different markets right now.
Yeah, what's interesting, though, is that the median selling price of an existing home did fall, the biggest drop since 2012. So that's quite interesting, because if it was just purely a supply issue, not a demand issue, maybe you wouldn't have seen that. However, prices did rise in the Northeast and the Midwest, so maybe it's different pockets are experiencing different types of demand.
Yeah, I'm just not sure. I'm not clear that there's an obvious macro signal coming off this. I think other data points are more useful in what is happening. I think the new home sales data probably tells such a different story at the moment that the market is kind of maybe a little bit more balanced. People are having to basically buy new homes. Anyway, it is another piece of data that we have to put into the pile of data that we're watching so carefully at the moment. We've got claims a little earlier on. The data in aggregate, Alex, I would argue, generally a little bit more positive at the moment, and that brings us to our question of the day. You put that side by side with the positive news we got yesterday or commentary from the president about the debt ceiling, and you wonder whether or not finally we could be in a position where we could break out of the recent ranges. And I'm talking about not just equity markets, but the bond market as well. So does a debt deal break us out of our range? That is the question we're asking Kriti Gupta and Liz McCormick. Liz, I want to start with you. Equity market's going sideways, doing absolutely nothing. There's some churn in the market, but the bond market is beginning to bump up against the top of the recent range. If we get a debt deal, are we going to break out? Are we going to see yields pushing significantly higher?
Yeah, like you mentioned earlier, Lori Logan kind of ginned things up today, saying, we're maybe not ready for a pause, and that got the two-year yield pretty high, over to 4%. But I think you're right. After the debt deal, kind of all the other dynamics come back, whether it's just more focus on the Fed, but also some people not kind of realizing that the Treasury Department, to deal with this debt limit quagmire, has had to kind of, we know they're doing extraordinary measures, but part of that is whittling down their cash buffer, which they like to have. So long story short, they're going to have to sell a lot of Treasury bills, and there's going to be a loss of liquidity in the way those dynamics work. And a lot of people are thinking this is kind of, going to be hugely important. It's almost kind of going to work possibly like another Fed rate hike. So I think that will push front-end yields higher as well.
Okay, it's super interesting, and I definitely recommend everyone read your article on that point. Kriti, is that we always think, debt deal, it's going to be good for stocks, break out of the range to the upside, but draining liquidity out of the system is never good for stocks.
It's really not, but in this case, I think it is because of the context. And the context really matters here. If you actually were to pull up the trading chart, essentially what you would see is they kind of drop down to the October lows of 2022, a big rise, and then that trading range of the last 2 months. But the problem is that momentum that kind of stagnated in April, that was a function of the debt ceiling debate, essentially. So the idea is simply that as you kind of take that problem, quote unquote, out of the works, that momentum continues. And you really see that with the earnings story, because even though from a commentary point of view, we're talking a lot about that consumer pullback, we saw that Walmart, Target, Home Depot, in the numbers, it's not showing up. And in saying that, look, the consumer's still strong, eventually they'll pull back. We don't have the timing on that. So until that timing, until it actually shows up in the numbers, the market is not going to really take it into account because of the carnage of last year. I think context is everything here.
Kriti, one of the key things about what has been going on in the equity market as well is that the equity market has got narrower and narrower and narrower. In order to break out, do we need to see the breadth kind of coming back a little bit? Do we need to see a focus on other areas other than 7 big tech stocks?
You definitely do. I think for a sustainable rally in general, this is just kind of the golden rule. You do need to have that breadth. And I think SocGen very specifically said that a good chunk of the rally that you have seen drive the tech rally within stocks has been really just a function of the AI frenzy. Is this a repeat of 2021? Not quite, because you are still seeing gains in some of the other sectors as well. I think retail is a fantastic example of that with Target and with Walmart, because sure, the numbers are really skewed in the favor of big tech on the AI story, on the cost efficiency story, but that's also a function of just how large they are. So you do need breadth, but I also don't think that just having tech leadership is necessarily a bad thing.
Interesting. Well, Guy, I think that also then raises the point, do we actually then see any upside on a debt ceiling deal in any respect? Like maybe yields today are going to be moving from what Lori Logan was saying, but if tech has already outperformed, like have we done the trade already at that point? Like you're going to go buy Target because you get a debt ceiling deal? I don't think so.
Well, you could argue you maybe would, because the consumer comes back. We were hearing from Ubish a few days back that the consumer has been a little worried about what's been happening in Washington, D.C., and maybe they do go back and spend a little bit more money. I'm not entirely sure that there's other evidence to support that, but maybe that is the case. I do, though, wonder about this liquidity question, though, Alex, and I think it is really interesting to kind of think about how the market is going to position from here. A lot of people are short, and I think that's something you need to think about in this. And positioning is one, but liquidity is such a key factor for equity markets. Liz, how big a drain could we be talking about? Because I'm putting this side by side with the fact that the Fed is still doing QT. We are still seeing liquidity being withdrawn from the market at a fairly reasonable clip. You put all this together, how big could it be? How short-term, big a short-term hit could we watch here?
Yeah, and I think you brought in the right context, and that's what the folks in this story, like Matt King at Citi, who's been really in the forefront of this, and Ari Bergman said, listen, we're talking about this drain of liquidity juxtaposed against this backdrop of the Fed QT, which some people feel like is going to start, to bite even more going forward, global central bank tightening, and that also, let's remember that the Fed could stay higher for longer, right? Which the market, the bond market is in pricing now. So all of that plus this, say, a couple $100 billion out of reserves at the least from these estimates people are saying for the bill issuance, et cetera. That's a decent drain of liquidity. So I think that for the bond market, that's going to be a focus. And these guys are kind of worried that it's going to bleed into other markets. I think what Treaty said makes total sense. You've got to, there's got to be a relief rally that the debt ceiling deal is done. But then it's going to look at, what's going on. And like somebody said to me, with short end, like the high yield savings, treasury bill rates so high, people can kind of take the beeline to cash if they're concerned, which kind of adds another kind of, I call it nervousness, easier to jump out of into risk off, like, oh, I'll just park my money and get almost 5%, right? So I think the liquidity thing is going to matter, especially if the Fed doesn't cut rates.
Yeah. Well, to that point, and Guy, I was just wondering that the short term, like go buy 90-day paper or go buy 3-month T-bills, like you have a nice yield, that changes. You're like, all right, well, I'm going to go put it in somewhere else. Maybe it does change sort of the dynamic of where things are actually flowing. Maybe they're not parked anymore in those short-term bills.
I do wonder what market that money belongs to. If it comes out, where does it go? I think is a question we still don't know the answer to. Well, maybe. I don't think it ever came out of tech. It certainly doesn't feel like that now. I appreciate the did for a short term. The other point that Liz raises is the fact that we've now got a more hawkish sounding Fed, and the market's now pricing in a 40% possibility that the next meeting delivers a hike. How much turbulence would a hike at the next meeting from the Feds deliver for the equity markets? How big a change would that be?
It would be a pretty substantial change because right now the market is pricing in that the Fed is done hiking. They're pricing in the cuts, and that's also part of the reason you're seeing the optimism. And I think it's worth mentioning and tying your earlier point in, guys, where does that money that's parked in those T-bills go right now? And I think a really key point is the FX market, which brings in back why the tightening policy really matters here, because that's the one dislocation that the market is really, really exposed to here. They're so convinced. It's not just the equity market, even the currency market. They're so exposed exposed to the idea that the Fed is done, that it kind of puts them in a little bit of a bind if you do see that hike. That being said, a really interesting point that a guest earlier on Bloomberg Television made, forgive me, I don't remember the name, was simply that because there's so much of a bets for dollars right now, given the debt default, as soon as that trade unwinds, there are certain asset classes like commodities, like EM, just have a built-in tailwind in it because of that unwind from the dollar. And that's something that I don't think enough people are talking about when it comes to risk-taking, specifically with emerging markets.
Yeah, you got to unwind the safety trades, right, and then you have to put it somewhere else. Looking at your dollar now, 107. That happened out of nowhere. All right, guys, thanks a lot. Kriti Gupta, Liz McCormick, wonderful conversation. We appreciate your time today. So coming up, it is more on this question of the day. Does a debt deal break us out of the range? We're going to get more insight from Lori Calvasina, RBC Capital Markets, head of U.S. Equity Strategy, next. This is Bloomberg.
If you don't take care of the nation's debt, if you allow the United States to default, virtually nothing else matters in terms of what you're trying to do around the world.
Where the data is not clear-cut. For us, that is perfect. It's the perfect Goldilocks backdrop where it's a bit of food for thought for the bulls, a bit of food for thought for the bears. You know, the rate cuts are not being priced out yet because we particularly see U.S. headline inflation go towards 3% in the next couple of months.
That was Max Kettner, Chief Multi-Asset Strategist at HSBC on Bloomberg TV earlier. Let's get to the question of the day. Does a debt deal break us out of the range? Joining us now, Lori Calvasina, RBC Capital Markets, head of U.S. Equity Strategy. Lori, does it?
Well, look, I think this is a complicated market, Alex, but I will tell you that some of the more bearish investors that I've been talking to, really more on the hedge fund side, the non-U.S. crowd, they have been very negative on the U.S., and the debt ceiling has been one of the things that's fed their negativity. So if you pull the debt ceiling as a risk off the table, I think at the very least it is going to, sort of quelch some of the pessimism that the non-U.S. Hedge fund crowd has had on U.S. equity markets, so it removes an important pressure point.
Laurie, good morning. It's Guy. Great to see you. If we do break out, do you chase it?
So look, some of my models have pointed to, upside to around, say, 4,300 on the S&P. I can get there from a valuation perspective. I can get there on one of my sentiment models. In general, though, I do feel pretty good about my base case of 4,100 on the S&P at year end. And that's not to say we couldn't overshoot it a bit in the short term, but I do think in general, multiples are about where they deserve to be. I think there's still some uncertainty in the earnings outlook.
We've had a very, very good reporting season, but there is still a lot of questions that investors have about the outlook for financials earnings in particular. I think it depends. The answer to that question, Guy, it's really whether you chase it. It depends on your time horizon. I think that short term, sure. Longer term, I do think that the tech trade in particular feels like it's starting to run out of catalysts, and that has really buoyed the market in here. I would just answer it by telling you I still like my 4,100 number at year end.
Okay, what I think is interesting here, Alex, is that the humans are very negative, and Laurie was just talking about some of the funds that she's been talking to. The machines aren't, but the humans are, and they are short. If you get a breakout to the upside, you could get quite a squeeze here.
Mm-hmm. Yeah, as a human, I am more negative. It is true. But Laurie, I have to wonder: is it the short squeeze to the upside, or is it a rotation within the equity market? Like we just sell tech and go buy materials or something. Like which is more likely?
So, I think that the rotation, I think if we see something that pulls people out of tech stocks and pushes them back into cyclicals, and I do think, areas like energy are very interesting, just given what's happened to them. But I feel like that might be a little bit of shorter duration just because that concentration in tech is so big. I think that a broadening out of the market, yes, it's healthy. I think a lot of people would like to see it, but it is that concentration in these big growth areas that has buoyed the market so far. So if you start to see some people pull money out of that and put it in the more cyclical areas, I feel to me like it's more of a short-lived rally. I will tell you, Alex and Guy, like the kind of scenario that I think really makes a lot of sense to me is really just the idea that people have been so deeply bearish. You see it on the AII survey. You see it on some of the work my derivative colleagues have done when they talk about how the up crash scenario just isn't being priced into market. So it could be some combination, right, of short squeezes. It could be some combination of just that fast money coming back in. It could also be a combination of some of that long-only money rotating. There are a lot of things that could get you to have a melt up in the short term.
How would a Fed rate hike at the next meeting upset all of that, Laurie?
I think that is a very important point, Guy, and I agree with a lot of what Kriti was saying earlier. I think the market has really priced to go on pause. I think a lot of the move in tech that, again, has buoyed the market this year has really been about pre-trading the pause. And it's funny, if you talk to my rate strategy colleagues, they will tell you that their base case is for a pause. They think we'll start to see some adjustment cuts towards the end of the year. But they also think the narrative has been pretty messy, and maybe people have been a little too quick to price out the terminal discussion. Mm-hmm. And I think that's, interesting as a risk factor. It's often, kind of these risks that are in like the 10 to 20% area that end up moving markets when they grow, even if they don't end up happening. So I think if nothing else, the conversation that you all were having earlier, that terminal's frankly back on the table in some respects, I think that's important, especially as we look at a market where this tech trade may be starting to run out of catalysts in the short term. The valuations are starting to feel about where they deserve to be. And if we start to throw, kind of cold water on the Fed, pause or cut discussion, that could be enough to get you a little bit of a pullback.
So, Guy, also interesting, headline crossing. Speaker McCarthy says he sees a debt limit deal on the House floor by next week. That feels pretty optimistic also. And it brings back the question, Guy, from earlier, which is, okay, if the debt ceiling is resolved, Treasury has to go out and basically replenish its savings account. They're going to issue a ton of debt, and that's going to also change, Guy, the liquidity issue.
Well, okay, so Laurie, how do you think about liquidity? I was always kind of taught that liquidity down, equity down, liquidity up, equity up. So if liquidity is going to be falling and the Fed's already pushing on that line as well, shouldn't that be negative for equities?
I generally think of it the same way, Guy. And, if you think about sort of just the size of the Fed balance sheet in the post-GFC world, there's been a pretty good correlation between rate of change in the balance sheet and rate of change in PE multiples in the S&P. So I certainly see it from a valuation perspective. And I think, we talked during the commercial break about how this market just feels like a very, very complex onion at this point in time. You peel a layer off. It looks all weird, and there are just more and more layers. I think there are just so many cross currents in this market right now that, again, I think debt ceiling is good news, but I do think we have all these other issues like liquidity, like the Fed. And by the way, what's happening with the economy, that could potentially cause markets to trip up a little bit in the short term.
Oddly as well, in the break, Alex described me as a complex onion. We're going to park that one for now.
But I was kidding. I mean, you haven't made me cry or anything, so there's that.
Yet. Laurie, great to see you. Thank you very much indeed. Great to have you on the show. Laurie Calvasina, RBC Capital Markets, head of US Equity Strategy. Still ahead, we're going to talk chips. Chipmaker Micron set to land more than $1 billion in investments from the Japanese government. It's going to be investing heavily. The Japanese government has got its back, it seems. Japan, it seems the place to be right now. We're going to talk more about this next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Simone Foxman. Walmart is raising its annual profit forecast after posting better than expected earnings in the first quarter. Comparable sales easily beat Wall Street estimates. Still, Walmart expects shoppers to remain under pressure this year. Shares of game maker Take-Two are surging. The company beat quarterly sales estimates and hinted of a release date for a new version of its popular Grand Theft Auto game. Take-Two's forecast calls for a huge rebound in fiscal 2025, leading to speculation that the new Grand Theft Auto would be out then. And hundreds of thousands of people got online to try for free flights to Hong Kong, being given away on Cathay Pacific's North America website. Almost 4,500 tickets from the U.S. and Canada were up for grabs, and they were gone within hours. The promotion is part of Hong Kong's plan to lure tourists back after virtually shutting down during the pandemic. And that's your Business Flash. Alex.
All right, Simone, thanks very much. It is 23 past 7 on the West Coast, so we want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Caroline Hyde. Caroline, thanks for doing this. So the hot topic is Micron and potentially getting $1.7 billion, $1.5 billion worth of basically incentives from Japan to manufacture chips there. Walk us through what we think we know.
Yeah, rather than Silicon Valley, we're doing Boise, Idaho, and this is where the company is, of course, based, but it is the last remaining real memory chip maker here in the United States. It's been impacted by the trade tensions between China and the US. They've been, of course, trying to dial back some of their own revenue dependence on China, which is about 11% year on year. So they're looking to expand their own supply chain and also feed in on the fact that every other country out there, developed world, tends to want to be diversifying their own supply manufacturing when it comes to chips too, wanting to get out of, in particular, China and Taiwan. And Japan is the perfect place to be doing that. Japan is going to be already an area of growth for Micron. They've invested a lot. They make manufacturing out there. This time, they're going to be using the money, the incentives, to basically help a European company, ASML, too. They're going to be buying equipment, chip equipment making stuff from ASML and some Japanese manufacturing so they can make really powerful EUV lithography made chips over there in Japan.
There you go. Lithography. That's the cool word.
Good job.
In all of this.
She said it, so we don't
Caroline,
have to.
I've got that one. Caroline, the UK, the UK Prime Minister in particular has come under a lot of criticism over the last few days for not being on the front foot when it comes to risk. We understand that the UK is going to announce a chips partnership with Japan. Rishi Sunak, the Prime Minister, is out at the G7 as well. What do we know about that?
Yeah, it's all ahead of the semiconductor strategy that's being announced tomorrow out of the UK, where, funnily enough, once again, a country is trying to diversify their supply chain. They're trying to make sure that they can make and get access to the chips that are in basically every manufacturing part, every car that we use, every phone, of course. And so the UK itself, we just had Rishi Sunak, I'm looking at the headlines, he clinches the Hiroshima Accord. But within that accord, and yes, a lot of that is money from Japan going into wind turbines in the UK, but it's also about the UK being able to gather manufacturing of chips in Japan too. So there's going to be this relationship that deepens as UK has to look at its own supply chain and has to say, look, a lot of it's dependent on Taiwan that people are geopolitically more concerned about, and indeed China as well. So once again, this is a global narrative that's going to keep on giving. How are people thinking about diversification post-COVID, post-US-China trade tensions?
Caroline, great stuff. Thank you very much indeed. You can catch Caroline a little bit later on, noon, New York time, Bloomberg Technology, around 90 minutes time. Some headlines crossing, actually, which may be relevant here. The Supreme Court leaving intact the social media liability shield. I'm sure Caroline will be talking about that a great deal on the show. The other piece of news I have to bring you is fairly sad, very sad. Equity Residential founder and chair Samuel Zell dying at 81, something of a legend when it comes to the property sector. I've always interviewed him with great pleasure and enjoyed talking to him. Anyway, Sam Zell dies at 81. This is Bloomberg.
into the U.S. trading session. Equities getting a bit of a lift now. It looks like we're having positive comments from Chuck Schumer as well as Kevin McCarthy over in D.C. Abigail's tracking some of these moves for us. Abigail?
Yeah, and if we flip up this board to the NASDAQ 100, a 4-day, we're going to see, Alex, very nice gain going into today, and they are being extended today. So up 2.8% here for the NASDAQ 100, and a piece of it, of course, is this optimism around some sort of debt ceiling deal getting done next week, potentially. Let's see. But right now we do have these gains. What's making it interesting is if we take a look at the first board that we had, the yield curve, we do have yield going sharply higher today. Typically, you wouldn't have big tech going higher on that. Now, we do have a divergence, of course, though, between China tech on the day and the NASDAQ 100. So here's the NASDAQ 100 going higher this year, China tech going lower. That may be a divergence worth watching because China tech can often lead the U.S., maybe the other way around, but going into last year selling, China stocks had been very weak, tech in particular. So this is, again, something to keep in mind. Now, returning to that debt ceiling optimism, if we take a look at the dollar on the day, we are going to see some real strength here. It is popping higher by about 0.5%. It was sharply higher, I believe, on Monday as well. So net on the week, probably up about this amount. The strength coming from yields being higher, and then, of course, also the idea that maybe a deal is going to get done, that would shore up the dollar. And then finally, for some movers on the day, if we take a look at the winner that is still leading, Walmart up 2%. They beat sales by 12%. They beat earnings, or excuse me, adjusted earnings by 12%. Sales by 2%. The outlook, they basically held. Some analysts not as encouraged by it. It's kind of interesting. A lot of mixed views out there, but the stock clearly going with the more optimistic view. Cisco paring its losses. That's outlook not so great. And then Alibaba down 5%. E-commerce buying. They missed their sales forecast, or they missed their sales estimate, Alex, I should say. E-commerce not doing as well. And for the first time, the cloud business saw a decline.
All right, Abby, thanks a lot. Really appreciate the setup. Thank you so much. Another stock we're watching, as Abby was just talking about, was Walmart. Earnings out earlier today. Simone Foxman is digging through. All right, walk us through it.
Yeah, shares up about 2%, but this is really interesting in part because we've already seen a street that is extremely bullish on Walmart. There were no sell ratings as we went into earnings yesterday, and that's largely because the stock has outperformed a lot of its peers, a lot of the rest of the market. That said, part of why we saw such an encouraging outlook here is not just what happens on the bottom or top line, but also that we saw a 7.4% increase in comparable sales in the United States. We saw stronger ticket sales. So while other retailers, the likes of Target, have reported weakening ticket sales, really what we're seeing from Walmart is beat to expectations. Now, does this mean that the consumer story that we've heard over the last couple of days needs to change? Not necessarily. Walmart in its earnings call, especially talking about how we saw higher income consumers really going to Walmart stores, buying even the higher end groceries at Walmart, a higher end beef than they'd normally been selling. Unfortunately for Walmart, though, that's a pretty low margin business, and so that's something to watch looking forward.
Simone, great stuff. Thank you very much indeed. Simone Foxman running us through the numbers on Walmart. We're joined now to analyze them a little further. Cole Smead, Smead Capital Management President. He owns Target. He owns Home Depot. He's got eBay in the portfolio as well as a number of more properties. Cole, what's the message from Walmart? What do you think of the numbers?
Yeah, there's just no precipitous decline in the economy right now, Guy, and I think that should frustrate economists and for people that own businesses that are out there, fighting the good fight, trying to find the consumer where they're at. It's not as bad as people would have said. So I think this just continues to show that the economy churns along, whether you're talking to Target, whether you're talking to Walmart. And it causes a lot of problems if you're, trying to figure out how to put inflation back into the magical bottle.
Well, Cole, are you bummed, though, that you own Target and not Walmart after the numbers over the last 2 days?
Well, I mean, if you look back 6 years, Alex, which would you rather own? I mean, Target's been the demonstrable winner in this game, and they haven't had to go after a lower margin business trying to grow, particularly online. People forget that 90% of what goes on in Target's online business is click and collect. It's one of the most remarkable transformations in an online business you'll ever find between that kind of omni-channel. You just don't find people that want to pick up their goods like that in most online businesses. And so no, we don't look at that at all. I think the real question for Target owners is, they're running about mid 30% ROE. Can we get back over 40%? What can go on incrementally right in the business, either tied to the types of items we're selling? Bed Bath & Beyond going away, awesome, fantastic.
Yep.
We chug along. We'll sell home
is it going
goods.
away?
Well, I mean, if anything that weakens it or lower store count is good for us. We would love to sell more home goods at Target, and that will likely give that to us.
Okay.
Now, whether Bed Bath & Beyond shows up in other store representations, I mean, even if Toys R Us showed back up again in numerous ways, is it the formidable force it once was? The answer is no. So that's the issue with it. Who can go out and grow at this higher return on equity like Target's doing? And if we gain marginal sales or profits moving forward, that really is where the stock will gain its multiple back, is going to higher ROE.
But part of the issue, Cole, with Target was also that we're just seeing lower discretionary spend. That you guys spend more on staples, you're going to go buy food, and you're not going to buy the other stuff. Walmart stands to capitalize from both of those things because they have the stuff, they have the pricing power, and they also have the food. Why do you think that doesn't play out negatively for Target?
Well, here's what I will say. Just if you look at incomes right now, the best thing going for Walmart relative to Target is the lowest income quartile in America is actually doing the best. They're seeing the largest wage gains. That's a Walmart customer. That is not as much of a Target customer, just so we're all on the same page.
Mm-hmm. What's going on in the world right now?
A Target customer is more likely to be an...
So just talk me through that customer story. What's going on? The consumer's not cracking. Yeah. When does the consumer crack? How long is it going to take for the consumer slowdown that we all anticipated to come through?
Yeah, to your point, Guy, it's going to be almost impossible, it looks like. How are they going to crack the consumer? They really have to get low-end wages crushed, because then they need those people to show up on the safety net benefits and showing up for unemployment insurance and those kind of things. That's just not happening. What's happening is richer people aren't seeing the same wage gains as poorer people. They're seeing their stock or bond portfolio get hurt over the last year. They're not feeling as confident, and that marginally affects Target in a way that it doesn't Walmart. But here's the other thing. Target got a huge benefit off the pandemic that no one really expected. And if you go look at the return on equity of the business and the multiples, that's really what Target's been reeling from in the last year, is shareholders that paid too much, that need to tax loss sell last year and this year. And that's where Target is. They've been really turning over their shareholder base from being a hype momentum pandemic stock.
So on a macro sense, are you trading macro right now? Like, I appreciate the talk about the consumer, but are you trading Fed stuff? Are you trading the debt ceiling? Like, how do you deal with the macro?
It's a good question. I would just say from a broad kind of framework perspective, Alex, short the fools. I mean, that's what we've been doing, short the fools. The inflation's never going to be a big problem. You want to short that idea. The economy's going to fall off a cliff as soon as the Fed begins tightening. Short that idea. Short the fool that's been out there saying those things for 2 years and has been wrong. And the weird part, Alex, is that hasn't become a widowmaker trade yet, right? It used to be that, shorting treasury bonds was the widowmaker trade. Well, it's not anymore. At the same time, the idea that inflation's going back in the bottle, people are being mocked and ridiculed for that. So we really like those bigger picture ideas. Where you go make money on that? I mean, to Guy's point earlier, the malls look like a layup. Go back and look at what Sir John Templeton was doing in the 1970s. He was owning retail assets, and that's what we're doing now. So the rhymes are all there, and the question, who wants to own those kind of things? I just think most market participants are lost because they can't own the S&P 500 and get fat and happy.
Hey, Cole, we love talking to you. Thank you so much for joining us. We'll get you soon. Cole Smead, Smead Capital Management President. This is Bloomberg. Back to that breaking news from earlier in the hour. Equity Residential founder and chairman Sam Zell has died at 81. We want to get more with Bloomberg's Wall Street correspondent Sonali Basak. Anyone in media loved Sam Zell. He was outspoken, he was feisty, he had interesting ideas. Do we know yet what happened?
We don't. The company had put out the release saying that he had passed away at the age of 81. They have announced that a former CEO will be taking over as the firm's chairman. Remember, Sam Zellman was the founder and the chairman of Equity Residential here, which, of course, we know was one of the big reasons he was and is still known to be really a leader here when it comes to not just the real estate business, but the publicly listed real estate business, really a pioneer of an industry that became a much bigger industry of REITs.
What should we remember him for, Sonali?
There are a few things, aren't there? There's this idea that he was a complete giant in the world of real estate, but people remember him also as somebody who was very keen and savvy investor when it came to distress and undervalued assets, which is why, as a journalist, it was such a joy to interview him. He would tell you what values would look like, where they were going, even if it was really bad. And he was also a deal maker. Remember, 2006, no one will forget when he sold Equity Office to Blackstone, and really at the time was a pretty historic deal. And then also his tour with the Tribune as well for an acquisition. He was a deal maker guy, and you know, there was a generation of deal makers at that time that were much bolder than some of the ones that we see today, particularly in industries like real estate. Remember, he was in the real estate business since college, and so this was really his life's work that he will be remembered for.
I remember talking about Bach and Riggs with him too. Like he had his hands in lots of different things. So you mentioned who's going to be taking over. What do we know about the hand that Sam still had in the business on a day-to-day basis?
Listen, he was an influential figure. There had a succession plan for a while there. So this is not as much about Equity Residential and the future of it. I think for now, there had been a transition. Sam himself was 81, but he was still a figurehead. And when you have a figurehead that is larger than life, I mean, your name will always be associated with that company. He was the founder of it. There were other things also that he had a lot of deep ties to. Remember, since he was born in Chicago, he had ties to places like Northwestern. He went to the University of Michigan, Wharton School, remember? So he actually had a lot of ties to big academic institutions as well, and it was part of his broader reach outside the investment community in some of the ways that he was a shepherd, a philanthropist, and really, you know, a big donor to a lot of these institutions.
When we think about him, he was always outspoken. Anytime I spoke to him, anytime I listened to him speaking, he was always incredibly outspoken. He had incredible views on most things. What do you think about the world that we live in right now, Sonali? How should we kind of think about what he leaves behind him in terms of what real estate really looks like right now?
That is an interesting question. I was thinking that when I heard the news immediately, and I've got to say I've been messaging with folks who have been working with him on different deals over time, and you know, the news has been shocking to the industry, of course, too. But you know, at a time like this, when people are hearkening back to, is this 2008? Is this not 2008? It's most likely not 2008, but we're worried about commercial real estate prices in the market. When people think about commercial real estate, people are forgetting this is multifamily residential as well. It's not just this concept of office buildings. So yeah, we've lost a very, very, very large voice in the room here on a day, frankly, where Moody's is coming out and saying 10% drop in real estate prices is the best case scenario without a recession, really. And it could be much, much worse if we face one. We're on a razor's edge, is what Moody's has said. So in this kind of time, you would get much more granularity on where you would see those prices drop very specifically across the United States and in what asset classes. Residential real estate in particular, do housing prices meaningfully drop?
Sonali, thank you very much indeed. This is Bloomberg.
Well, fighting inflation might have hit another roadblock. The U.S. drought is shrinking the wheat harvest here, and it's gotten so bad, domestic buyers are having to actually import wheat from Europe. Now, the worry is that that could potentially make food inflation a lot stickier. We're joined now by Patrick Bowes, CEO of the Andersons, a giant crop handler. You did all the things, you have your hands in lots of different areas. I just want to get your take, like how structural is this?
Yeah, well, it's really been pretty located to one region, which is we call the Desert Plains area, including Kansas and Texas, which is really pretty drought-stricken, which is a hard wheat, which goes into milling quality for bread making, et cetera. Other crops are in good shape. It's really kind of that more region that's been hit the hardest.
But to the bigger point, Patrick, good morning, it's Guy.
Morning, Guy.
Food inflation is something a lot of people are paying a lot of attention to right now. What is your sense of what is happening? Prices have been coming down, ag prices have been coming down. Do they continue to fall? What is your outlook for food price inflation currently?
Right. Well, food price inflation really took off after the Ukraine war when commodity prices really skyrocketed, which included fertilizer prices and grain prices. They've come down pretty dramatically here in recent months. Most of that is off good weather that supported Brazil production and the outlook for a good crop in the U.S. We've had good planting conditions, so we expect the corn and soybean crops in the U.S. to be really good. So we could see a little weakening of commodity prices, which should help kind of curb some of that food inflation.
So how does that trickle down to you? So if that's the kind of the setup, is that good or bad for your business? What does it mean for your top line versus, say, your margin story?
Yeah, we've been able to really grow our company over the last 5 years from $3 billion in revenues up to $17 billion in revenues. But our focus is all about volatility. So when you have volatility in markets, that creates opportunities for merchants to be able to, take positions and move products around the world. That's what we do. So whether it's a high grain price or low grain price isn't so specific to our earnings. We just like to see the volatility and the change.
Patrick, that's quite some pickup in the top line. Can you continue to grow at that kind of rate? What are you looking at over the next few years?
Yeah, we continue to see growth. We've been able to move out of conventional, grain and fertilizer into some new areas around sustainability. We have a big ethanol business. We've been doing things in renewable diesel feedstocks, so the purchasing and collection of vegetables like corn oil and others, and supplying the big oil companies that are in the renewable diesel side. So a lot of things in agriculture are shifting towards sustainability, and those create some new opportunities that didn't exist before.
Were those opportunities going to be profitable? If so, when?
Well, some are profitable right now. So right now we're seeing our ethanol business is doing very well right now. Ethanol margins have improved pretty dramatically. Corn oil values, because of renewable diesel, have driven up well over $1, and so it's been good returns for that. Some are longer term. So when we talk about being able to do sustainable aviation fuel technology is something that's still coming, to do things in carbon sequestration. The things we're looking at are also working with growers on regenerative agriculture and how you're going to apply carbon practices at the farm level. So those are a little bit more longer term and not as profitable right today.
Patrick, is this an M&A story? Is that how we should be thinking about it as well? Is this all organic growth, or are you going to be growing by acquisition too? And if so, in what areas? Something you've just laid out a whole load of them. Where do you see the biggest opportunity?
Yeah, good question. So we've been able to make successful acquisitions. We acquired Lansing Grain, which is one of our bigger acquisitions, 2019. And we've done some, I'd call them single and doubles, bolt-on acquisitions, smaller business that we brought in, several of them over the last year or two. And we look to continue to do that, but just continued putting capital to work in our existing assets, building out our supply chain that we have today. So it's going to be a balance. Some of organic growth with some inorganic growth. So some new acquisitions in spaces where we need some additional capacity. So it's going to be a little bit of both.
Like what? Like what does that look like? Is that just bolt on to your current operations, or is that like, you know what, I want to really beef up renewable, sustainable aviation fuel, I'm going to go make that acquisition?
Right. So good point there. In the case of sustainable aviation fuel, it's a mouthful.
Yeah,
SAF, there isn't anything to buy because it's building new plants, right? So we need to get our ethanol plants to be, that we think they're top decile, really good operating plants. We need to do carbon sequestration of those plants to make them lower CI scored to be able to do SAF down the road. So that's one thing we're looking at. And also I mentioned the renewable diesel feedstocks. We've done about 1 billion pounds of supply in that business. We'd like to double that. So we're working to increase the feedstock supply to renewable diesel industry.
That's interesting.
Patrick, can I just ask you a quick question on SAF?
He's the plane guy, by the way.
Yeah.
I'm the energy person.
Guy.
He's the plane guy, just so we're clear.
Right. and I'm totally with you. SAF is the most ridiculous name. It sounds silly every time it comes out of your mouth, and it's incredibly hard to say. But let's talk about it. The targets are incredible. The scale up is going to be enormous. What is your sense of how realistic some of these targets are?
Yeah. Well, I think about it, and maybe it's because I've had a very long career in this industry. So I, started over 40 years ago, before ethanol even got started. It was early days of gasohol, and then that industry really took off. And I was involved in building some of the earliest plants in the ethanol business, and it really, grew to be well over 200 plants today. So we need to think about the long-term aspect here. We're going to be able to have a growth in e-vehicles in this country that's going to help on the carbon side, but really doing something about aviation fuel will make a big impact. So it's a real shot in the arm for the ethanol industry because there's two routes, both the renewable diesel route and the ethanol to jet route. So this technology is really important, but now it's a scale up and driving down of the cost and trying to get it to be a big, efficient supply chain and partnering with the key players in the oil and gas industry to make this happen.
Has your life gotten harder or easier since the pass of the IRA? Because it feels like there's going to be a lot of money coming out of D.C. really fast. So does that sort of move up your timetable to kind of make the deals and get things done?
Yeah, I think for everyone that the IRA has put a little more speed to this, especially things related to carbon reduction. The challenge in today's environment is just getting things built is not easy. So I don't know if it's housing or office buildings or in our case big industrial plants, it just takes longer. It's more expensive. So these ramp ups are taking a little longer to do. So the question is what will happen with the IRA? Will there be some extensions because people want to push to see some of these new greener energy projects come online? So that will be kind of the next phase, how long it's going to take to get these done.
Patrick, we're going to leave it there. Great to catch up with you. Thank you so much for joining Alex in New York. We really appreciate it. Useful conversation. Patrick Bowe, the Andersons CEO. Let's talk a little bit about what is happening with these markets. You can see them there in front of you. The Stock 600 up a little bit today, maybe on some optimism out of the United States on the debt ceiling. Burberry down. US market soft. We kind of knew that, but maybe actually some inklings, some softness out in Asia as well. But here's the story I really want to talk about. Natural gas, the Dutch contract, below 30. That is the first time we have seen that since June 2021. It is down 6.58% again today. And if you look at some of the forward contracts into next winter, it continues to fall as well. Up next, what do we need to talk about? We need to talk about what's happening in European markets. I want to talk about what's happening in Japanese markets as well. Is Japan the place to be right now? Is that where your chips should be? The European close is coming up. Christian Muller-Glissman, Global Head of Asset Allocation Research at Goldman Sachs, is going to be joining us next. This is Bloomberg. Thursday, the 18th of May. Dare I say it, a little bit of movement in European equities at an index level today. Technology is by far and away the outperforming sector today. Why? ASML is on a charge. ASML is on a charge because it's about to sell a lot of equipment to Micron, which is going to be investing a lot of money into Japan. We're going to be talking about Japan and the story that we're seeing there in just a moment. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Let's talk about these markets. Let's see what's happening. 600 up by 0.4%. Got a little bit of movement. The German market in particular pushing on a little bit today. Single stocks are interesting. I've talked about ASML. It's doing well off the Micron news. It could be supplying an awful lot of chip equipment making to Micron. Equipment. Missed that equipment there. To Micron. Easier just to say lithography. So the stock 600 is up. Easy